The shock that most investors are not prepared for is not just a headline about Iran, oil, or war. It is a chain reaction. That is the part people miss. They look at a geopolitical event and think it is one event. They look at the price of oil and think it is one price. They look at a market decline and think it is one bad day or one bad month. But markets do not work that way. Economies do not work that way. Risk does not work that way. A shock moves through a system. It starts in energy, then it moves into transportation, then it moves into production costs, then it moves into inflation, then it moves into central bank decisions, then it moves into corporate margins, household spending, employment, and finally asset prices. By the time most people understand what happened, the first move is already over, the fear has already arrived, the selling has already begun, and the opportunity has already been transferred from the unprepared person to the prepared person. That is why I want you to listen carefully. The important thing is not whether a person can predict every detail of what comes next. Nobody can do that. The important thing is whether you can understand the machine well enough to avoid being controlled by it. Most investors will be surprised by what is coming because they look at markets as prices on a screen. I look at markets as cause and effect relationships. When oil prices rise sharply, it does not only affect oil companies, it raises the cost of moving goods. It raises the cost of producing goods. It raises the cost of operating businesses, it pushes prices higher at the store, it pressures the consumer, it squeezes the middle class, it makes weak businesses weaker. Then inflation rises, or at least the fear of inflation rises. When inflation rises at the same time the economy weakens, the central bank has a problem. If the Federal Reserve cuts rates to help growth, it can feed inflation. If it keeps rates high to fight inflation, it can increase pressure on households, borrowers, small businesses, and markets. That combination is what people are afraid of. It is the environment where people begin to use the word stagflation. High inflation, weak growth, falling confidence, pressure on employment. A central bank that cannot easily rescue the market without making some other part of the system worse. That is not an easy environment, but it is not a new environment either. History has many different names for the same basic pattern. Sometimes the trigger is a war, sometimes it is a banking crisis, sometimes it is a technology bubble, sometimes it is a pandemic, sometimes it is inflation, sometimes it is an energy shock. The names change, the machine repeats, markets rise, become expensive, become crowded, get shocked, fall, overshoot, create fear, transfer assets from weak hands to strong hands, then begin again. That is the cycle. It has happened again and again for more than a century. The investor who has never studied this cycle thinks a crash is the end of the world. The investor who has studied it understands that a crash is a test. It tests your liquidity, it tests your temperament. It tests whether you own good businesses or only good stories. It tests whether you have a system or only emotion. And most importantly, it tests whether you can do the right thing when your body is telling you to do the wrong thing. When everyone is calm, everybody thinks they are a long-term investor. When prices are rising, everybody thinks they understand risk. When liquidity is everywhere, everybody thinks they have conviction. Then the shock comes. Oil rises, inflation fears return, the Fed gets trapped, stocks fall. Commentators become loud. People who said they were long-term investors begin checking their portfolio every 10 minutes. That is when you find out who has principles and who only had a mood. I do not want to be in the group that gets wiped out because it confuses volatility with permanent loss. I also do not want to be in the group that blindly buys anything that falls. Both mistakes are common. Fear is dangerous, but blind courage is also dangerous. A decline by itself does not make an asset attractive. Something falling 50% is not a reason to buy it. Something surviving a crisis, continuing to grow revenues, protecting margins, and becoming more important in the system is a reason to study it carefully. That is the difference. The point is not to chase the crisis. The point is to use the crisis to acquire the assets that will matter after the crisis. When I study a coming shock, I do not ask only what will go up next week. That is a trader-esque question. I ask, what part of the system becomes more important over the next 10 years because of this shock? That is the investor-esque question. And when I apply that question to the world we are looking at now, the answer is not simple oil speculation. Oil may rise, oil may fall. It may trade at one level for a few months and another level a year later. Oil is cyclical. It moves with supply, demand, politics, wars, reserves, OPEC decisions, production incentives, and the behavior of countries that often do not act the way investors want them to act. Owning oil simply because oil is rising can work for a time. But if your horizon is 10, 15, or 20 years, you need something more durable than a commodity price move. The same is true of going completely to cash. Cash feels safe when prices are falling, but over long periods of time, cash is not neutral. Inflation quietly takes from it. The nominal number may stay the same, but the purchasing power erodes. A person can sit in cash feeling safe and still become poorer in real terms. That is one of the biggest lessons ordinary investors learn too late. Crashes are visible. Inflation is quiet. Crashes frighten you quickly. Inflation impoverishes you slowly, and most people are more afraid of the thing they can see than the thing that is steadily reducing their future. I also do not think the answer is to gamble on every defense contractor or every so-called defensive stock because there is a crisis. Those can have a place. Certain businesses can perform better during certain shocks, but a crisis trade is not the same thing as a long-term wealth strategy. A telecom stock may hold up in one environment, a healthcare stock may behave defensively in another. A consumer staples business may give people comfort when markets are falling, but the question is not only what survives a difficult year, the question is what compounds for a decade. That is where I want the focus. In my experience, the biggest wealth is made when high-quality assets that were already aligned with long-term forces become temporarily available at prices caused by short-term fear. That is the opportunity. Not panic buying, not hero trading, not calling the bottom, not borrowing money to prove how brave you are. The opportunity is having a clear list before the fear arrives, then using weakness to accumulate the assets that fit the world that is being built. The world being built needs reliable power. It needs AI infrastructure. It needs memory. It needs semiconductor production. It needs software that helps organizations make decisions in chaos. It needs cybersecurity. It needs databases, cloud infrastructure, automation, robotics, advertising, efficiency, payments, and productivity tools that make the real economy function better under pressure. That is where the logic starts. If the Iran shock creates higher energy prices, renewed inflation pressure, and market weakness, I do not want to respond by simply chasing the assets that already moved. I want to ask which businesses the world will still need more of when the panic ends. The first group I think about is energy, but not in the simple sense. I am not talking only about owning oil because oil went up. I am talking about power that is tied to the AI supercycle, the electrification of the economy, data centers, grid pressure, and the need for reliable supply. AI is not an abstract software story. AI needs electricity, AI needs cooling, AI needs data centers. AI needs systems that can operate at large scale without breaking. When people talk about artificial intelligence, they often focus on the application layer, the chatbot, the model, the exciting visible product. But the deeper layer is physical. You need power, you need cooling, you need chips, you need memory, you need networks, you need factories, you need uptime, you need infrastructure that makes the digital world possible. That is why the energy sleeve matters. A company connected to nuclear power, a company connected to data center cooling, and a company connected to on-site energy production, each solves a different part of the same problem. One is about reliable generation, one is about keeping the machines running, one is about producing power closer to the point of demand and reducing dependence on a strained grid. The names I have watched in that group include CG, VRT, and Bloom Energy. The point is not that any single ticker is magic. The point is that they represent a principle. If AI becomes more important, the physical systems that make AI possible become more important. If the grid becomes more strained, the companies that help reduce that strain become more important. If energy becomes a geopolitical pressure point, reliable power becomes more valuable. That is the first piece. The second piece is memory. This is less obvious to many people because the market spends so much time talking about GPUs. GPUs have been the center of attention, and for good reason. But as AI becomes more complex, as models need more context, as agents become more capable, as companies ask AI systems to do more things over longer sequences, the need for memory rises. It is not enough to compute. The system has to store, retrieve, process, and move huge amounts of information efficiently. When complexity rises by a large amount, memory demand can rise with it. And the world was not built with unlimited high-bandwidth memory ready to go. That creates a bottleneck. Bottlenecks are important in investing. When demand rises faster than supply can respond, the owners of scarce capacity can benefit greatly. The memory market is concentrated. A small number of companies control a very large share of it. Building new capacity is not quick. You cannot simply wake up, decide to produce high-bandwidth memory at scale, and meet the needs of AI infrastructure immediately. These supply chains take time, capital, skill, and manufacturing experience. That is why a company like Micron matters in this framework. There are also non-use players such as SK Hynix and Samsung. They are important in the global system. But if the goal is to keep a US-centric portfolio, Micron is the one that naturally comes into focus. Again, the point is not to say a person should chase a stock after a move or buy without doing the work. The point is to recognize the bottleneck. AI needs memory. Memory is scarce. The companies that can provide the right kind of memory may have years of demand ahead of them if the AI cycle continues. When I look at a company in that category, I do not only look at the price chart, I look at revenue growth, I look at free cash flow, I look at whether the company is positioned in the exact part of the supply chain that becomes more valuable as AI grows. I look at whether the company is supplying what the system cannot easily do without. That is how I think. The third piece is production. This is where many investors get excited, but they often do not organize their thinking properly. The AI and semiconductor world is not just one company, it is a production chain. There are companies that design chips, there are companies that manufacture chips, there are companies that make the machines that allow chips to be manufactured, there are companies that provide the design software, there are companies that provide connectivity, there are companies that supply the infrastructure around the whole system. If you understand the chain, you are less likely to be fooled by the headlines. NVIDIA and AMD are central because they address the GPU side of the bottleneck. ASML is central because advanced semiconductor production depends on lithography machines that are extraordinarily difficult to build. TSMC is central because so much of the world's advanced chip manufacturing depends on it. ARM and Cadence represent parts of the design side. AEIS represents connectivity and the systems that help the whole machine operate. When you put those pieces together, you begin to see that the production layer is not one trade, it is an ecosystem. And in times of geopolitical stress, production capacity becomes more important, not less. If supply chains are fragile, the companies that control critical production steps become more strategic. If countries compete over technology, the companies that make the technology possible become more valuable. If AI demand keeps rising, the companies that remove bottlenecks become more important. This is why I do not want to simply ask which stock is popular today. I want to ask which companies sit at unavoidable points in the system. An unavoidable point is a place where the economy has to pass through if the trend continues. That is a much better way to think than trying to guess the next headline. The fourth piece is decision making in chaos. This is where Palantir fits in the source logic. Whether a person loves or hates the stock is not the main issue. The underlying concept is more important. In periods of instability, organizations need to make decisions under uncertainty. Governments need to understand complex situations. Companies need to manage supply chains. Defense systems need coordination. Large institutions need to integrate data, identify risk, and act faster than competitors. Chaos increases the value of systems that help people see, decide, and respond. That is the principle. Palantir is one example because it is positioned around decision making in complex environments. CrowdStrike is another example on the cybersecurity side because digital systems become more vulnerable and more important. At the same time, Datadog and MongoDB fit on the visibility, monitoring, and database side. Oracle, Microsoft, Google, and Amazon fit through cloud, database, and infrastructure roles. I do not think about these names as isolated stock tips. I think about them as different organs in the same body. The more complex the world becomes, the more valuable the systems are that allow companies and governments to operate through complexity. This is also why the strongest businesses often get stronger after a shock. Weak companies spend the crisis trying to survive. Strong companies use the crisis to widen their lead. That is repeated many times in history. Amazon is a useful example of the principle. It survived major downturns. It was damaged in the short run. Its stock price experienced large drawdowns, but the underlying business became more important. Over time, the market followed the business. That is what I care about. Not the daily panic, not the opinion cycle, not whether a stock goes down next week. I care whether the company becomes more important over the next 5 or 10 years and whether the financial results eventually reflect that. The fifth piece is automation and real-world productivity. When inflation rises and growth slows, businesses look for ways to do more with less. That is not a slogan. It is a survival requirement. If labor costs rise, if financing costs remain high, if input costs increase, if uncertainty makes companies more cautious, productivity becomes very valuable. Technology that increases productivity becomes a hedge against a harder operating environment. Tesla fits into this discussion through robotics and autonomous driving. Meta fits through advertising efficiency and the ability to lower the cost of reaching customers. Amazon fits through the combination of AWS logistics, retail data, and automation. SoFi and Robinhood fit into the financial technology side of the consumer and investing ecosystem. You can disagree with any single company. That is fine. The principle matters more than the name. The principle is that a difficult macro environment does not eliminate innovation. It often makes the winners more obvious. The companies that help people and businesses operate more efficiently, make better decisions, lower costs, automate tasks, move money, and use data are the companies that can gain importance when pressure rises. Now, it is important to connect this back to portfolio construction. Having the right watch list is not the same thing as having the right strategy. A person can identify good companies and still lose money if the process is bad. That happens all the time. They buy too much too quickly. They use margin. They panic when the position falls. They get greedy when the position rises. They confuse a good company with a good entry point. They confuse conviction with stubbornness. They confuse research with a video they watched once. That is why I believe systems matter. A good system should assume that you do not know the bottom, because you do not. No one does. If you buy too quickly and the market keeps falling, you can run out of cash before the real opportunity arrives. If you wait for perfect certainty, you may never buy at all. So the process has to balance patience with action. That is where a disciplined dollar-cost averaging approach can be useful. You build slowly. You buy in phases. You keep enough liquidity. You do not use margin. You do not borrow to buy assets that can fall far more than you expect. You do not panic buy because a stock is down. You do not panic sell because a headline is frightening. You create rules before the emotion arrives. Because once the emotion arrives, it is much harder to think clearly. The portfolio also needs a core for most people. That core can include the S&P 500. It is easy for people to become overconfident and think they can beat the market only with individual stocks. Some can, most do not. And even people who can still benefit from a stable core that reduces the risk of one idea becoming too important. The core is not exciting. That is why it is valuable. Excitement is not the goal. Compounding is the goal. A core holding gives the portfolio a base. Then the individual companies become satellites around that base, focused on the parts of the economy that are most aligned with the future. This is not a recommendation for anyone's specific situation. It is a way to think. You need a base, you need rules, you need liquidity. You need patience. You need a list of companies you understand before panic arrives. You need to avoid debt, and you need to know what would make you wrong. That last point is essential. A real principle includes the conditions under which it stops working. If a company no longer grows revenue, if margins deteriorate, if the competitive advantage weakens, if the product becomes less important, if management loses discipline, then the thesis changes. You cannot simply say, I am a long-term investor, and ignore reality. Long-term investing is not blind loyalty. It is a disciplined relationship between price, fundamentals, and time. That brings me to the most important part of the entire framework over the long run. Prices follow revenues, profits, and margins, not perfectly, not every month, not every year, but over time, the market eventually has to recognize the economic engine of a business. People will talk about price-to-earnings ratios. They will talk about insider selling. They will talk about competition. They will talk about whether a company is too loved or too hated. Some of those things can matter, but the deepest question is simpler. Is the company increasing revenue? Is the company expanding or protecting gross margins? Is operating margin improving? Is net income growing? Is free cash flow improving? Is the business becoming more important to customers? Is it becoming more embedded in the system? If the answer is yes, and if the price becomes attractive because of fear, that is when opportunity appears. That is how some of the great moves of the past happened. A company looked expensive to people who focused only on the wrong metric. It looked risky because the news was noisy. It looked controversial because everybody had an opinion. But the financial engine kept improving. Revenue rose, margins expanded, the business became more important. Eventually, the stock followed. That is why I do not get overly emotional about the coming shock. If it happens, there will be red on the screen, there will be fear. There will be people telling you that this time the market will not recover. There will be people saying the world has changed forever. There will be people selling quality assets because they cannot tolerate uncertainty. But uncertainty is not new. War is not new. Inflation is not new. Crashes are not new. Policy mistakes are not new. Human panic is not new. The world has always had reasons to be afraid, and yet businesses that solve real problems, produce real profits, and become more useful to society have continued to create wealth across cycles. This does not mean every stock recovers. Many do not. It does not mean every high-growth company is worth buying. Many are not. It does not mean you should be careless. Carelessness is punished. But it does mean that the person who understands the cycle can use fear differently from the person who is controlled by it. When the shock comes, most people will ask, how do I make the pain stop? The better question is, what is the system offering me now that it would not offer me when everyone was euphoric? That is the difference between a reactive investor and a principled investor. A reactive investor lets the market decide his behavior. A principled investor decides his behavior before the market tests him. So I would prepare in a simple way. I would identify the companies tied to the durable future, not the temporary headline. I would separate energy infrastructure from short-term oil speculation. I would separate AI bottlenecks from AI hype. I would separate semiconductor production from social media excitement. I would separate decision-making software from ordinary software. I would separate productivity and automation from fashionable stories. Then I would watch fundamentals, revenue, margins, cash flow, balance sheet strength, mission-critical position, competitive advantage. Then I would buy slowly with discipline, without leverage, and without pretending I know exactly where the bottom is. That is how you make a crisis useful, not by being reckless, by being prepared. There is a saying that investors like to repeat about buying when there is blood in the streets. The saying is useful, but incomplete. You do not buy everything because there is blood in the streets. You buy the things that will survive the blood, compound after the blood, and become more important because weaker competitors could not endure the blood. Survival is the bridge between crisis and wealth. A company that cannot survive a crisis is not cheap just because its stock is down. A company that survives, strengthens, and gains share can become a generational asset when bought during fear. That is the logic. This is why I think the coming period could be dangerous and full of opportunity at the same time. Danger and opportunity are often the same moment viewed through different levels of preparation to the unprepared person. Volatility is only pain. To the prepared person, volatility is information and potential entry. To the gambler, volatility is an invitation to go all in. To the principled investor, volatility is a reason to move slowly. Use rules and keep the long-term picture in mind. The long-term picture is still driven by productivity, innovation, capital allocation, profit growth, and the ability of the best companies to solve the most important problems. The world will still need power. It will still need data centers. It will still need memory. It will still need chips. It will still need cloud infrastructure. It will still need cybersecurity. It will still need software that helps people make decisions. It will still need automation. It will still need better financial platforms. It will still need companies that help civilization function through disorder. That is what I want exposure to. Not all at once. Not with borrowed money. Not because someone shouted that history is about to be made, but because the deeper forces are already moving and a shock may create the prices that long-term investors rarely get when everything feels comfortable. Comfort rarely gives you the best opportunities. Fear often does, but only if you have the discipline to use it. The key is to understand that the next decade will not reward people who simply chase what moved yesterday. It will reward people who understand which systems are becoming essential. It will reward people who can endure drawdowns without losing their minds. It will reward people who can distinguish a temporary price decline from a permanent impairment of the business. It will reward people who know that inflation can be more dangerous than volatility. It will reward people who build portfolios with a core, a process, and a list of exceptional businesses tied to durable trends. That is the message, the Iran shock. If it arrives the way people fear, may be the visible event. But the deeper story is how investors respond to shocks. Do they run? Do they gamble? Do they freeze? Or do they apply principles? Principles matter most when the world is loud. The principle here is simple. Own quality, keep a core, avoid leverage, buy slowly, focus on real fundamentals, understand the cycle, use fear instead of being used by it. And above all, remember that the market is not there to make you comfortable. It is there to transfer money from those without a plan to those with one. That transfer can happen during euphoria, it can happen during panic, it can happen during wars, inflation scares, recessions, pandemics, and crashes. The events change, the behavior repeats, the prepared investor studies the behavior, the unprepared investor reacts to the event. I do not know the exact timing of the next shock. I do not know whether oil rises more before it falls. I do not know where the bottom will be in any individual stock. I do not know which headline will dominate tomorrow. But I do know this. The world is becoming more complex. The demand for energy, computing, memory production, data, cybersecurity, and decision making is not going away. The best companies in those areas will not be immune to a crash. They may fall hard. They may fall harder than people expect. But if their revenues, margins, and importance keep improving, the decline may be the very thing that gives disciplined investors their chance. That is how history usually works. Not because history repeats perfectly, it does not. History rhymes because human nature repeats. Fear repeats. Greed repeats. Overconfidence repeats. Panic repeats. And the tendency to sell good assets at bad moments repeats. The job is to be on the right side of that repetition that requires preparation before the event. It requires knowing what you own. It requires knowing why you own it. It requires having a system for adding when prices fall. It requires accepting that you will never feel comfortable buying during true fear. If it feels comfortable, it is probably not true fear. The opportunity comes when the facts still support the long-term thesis, but the emotion of the market has temporarily overwhelmed the price. That is the moment you prepare for. That is the moment most people miss, and that is the moment that can shape a decade. So when the headlines come, do not let them make you small. Do not let them force you into panic. Do not let them push you into cash forever. Do not let them tempt you into leverage. Do not let them make you chase oil, chase defense, chase whatever moved first. Slow down. Look at the machine. Look at the cause and effect. Look at the companies that will matter when the smoke clears, then act with patience. That is how you turn a shock into a plan. That is how you defend your portfolio without surrendering the upside. That is how you prepare for a crisis without becoming a victim of it. And that is how real wealth is usually built. Not in the loudest moments, not by the most emotional people, not by those who predicted every headline, but by those who understood the cycle, respected the risk, kept their liquidity, bought quality slowly, and allowed time to do what time does for great businesses. The next panic will feel new. It will not be new. The headlines will feel historic. The behavior will be old. The opportunity will belong to the people who can see the difference.